The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
It's Friday, and we're talking about money today. Today we're going to be talking in part about what The Economist magazine calls this time of year, which is the carnival, what they call the carnival because of what's going on in the investment field. We're going to come back to that. It's not just market related, and yet it is market related. We're going to talk about that some today. I also want to talk about what some consider the greatest hoax of the 20th century. Involves painters, involves the Nazis. Very, very interesting story. Also has some application to investments. So we'll be talking about that. That's coming up later in the program. And I also have a guest today. He was with us 5.5 years ago. 5.5 years ago. His company's made tremendous progress. It's grown 6-8 times over during that period of time. Is probably the best recognized firm in its field. So you want to hear what he has to say. It has to do with the internet. It has to do with the future. You got to hear what he has to say. It may apply to your business. But let's begin with earnings. Right now is the first quarter. Earnings are being reported. 500 companies in the Standard & Poor's 500 will start to report earnings. And earnings are like in real estate, location, location, location. It's earnings which really count. It's what a company earns. The cash that flows into a company comes from one of three sources. It comes from earnings, it comes from issuing capital stock or equity, it comes from borrowing. But the safest thing is earnings. And for a company to grow or to pay dividends, it has to have some earnings. And this time, right now, is when companies are reporting earnings. It's important. You look at people talking about the price-earnings ratio. That's an indication of how the stock price is doing compared to how the company's earning more. And you'd expect if a company continues to grow its earnings, its price should go up. And that's what a lot of people focus. They focus on that quarter by quarter. And you have analysts that project what the earnings are going to be, and if they miss by 1 penny, if the earnings are $2.30 and they're projected to be $2.31, that stock can take a 10% drop or 20% drop. It's crazy. It's idiotic. In my opinion, it's really idiotic. But it goes beyond that because there's strict accounting for American firms. Not so much so in some of the foreign companies, but for those that are domiciled in the United States, there's strict accounting rules. And as we came out of the 2007-2008 period, most of the earnings announcements were pretty straightforward. Most of what company CEOs had to say, what CFOs had to say, was pretty straightforward. But The Economist now points out, and I believe they're absolutely correct, that what we've gotten seems to be a carnival of confusion. They're talking about CEOs creating small fibs or even large fibs. They said fibs that could embarrass a presidential nominee. It's something that would make a presidential candidate blush because the CEOs are sounding like salesmen. They're sounding like stockbrokers trying to sell their own stock. I agree completely when you listen to what they say. Think of the largest cap stock there is, Apple. Their revenues took a drop. That's the first time they've taken a drop in almost 13 years. It was 2003 since their revenues went down. And the CEO of the firm, Tim Cook, came out and he said, "We executed very well." Wait a minute. If the revenues went down, how did you execute very well? If you're beginning to shrink, how are you executing very well? People are saying they need another product, they need other things. But for Tim Cook, it was executing very well. IBM, look at IBM, one of the great companies, one of the blue chips. It's been a blue chip for a long time. Their pre-tax profits were down 66%. So how did the CEO address that? Gene Romantis boasted that they were in a transformation process and that they were looking for double-digit growth down the line because they had strategic imperatives to fulfill. This doesn't sound like a straightforward, honest answer. It sounds like salesmanship, trying to paint a picture, trying to paint a better than realistic picture. Most recently, we saw the company Valiant, a drug company that invented their profits. Their managers actually invented their profits. It wasn't until everything began to collapse and the stock price collapsed that we realized it. Sun Edison, they have what the economists call voodoo metrics to describe their earnings. Sun Edison went out and raised capital and debt, $400 billion, to put in large solar farms and wind farms. They raised $400 billion. And they wanted to pay huge dividends. They wanted to say, we're paying huge dividends. And they were paying huge dividends. And they spun those farms out into separate little companies so that they really confused what was really going on. The truth hit a couple weeks ago when Sun Edison filed for bankruptcy. It wasn't as rosy a picture as they painted. Want to bring it closer to home? Look at Microsoft. If you look at Microsoft's earnings, their profits either rose by 6%, or they dropped by 3%, or they sank 25%. Depending upon what metrics you use for comparison, they were either up 6%, down 3%, or down 25%. It all depends upon how you look at the earnings and how they present it. They present it in a very positive fashion as plus 6%. According to The Economist, this Economist article, it said in 2015, 232 firms in the S&P 500 had a cash flow that was below the amount of earnings. That's a really surprising thing. But I've talked a long time about the blue chips becoming black and blue chips. We're in a process where leadership is changing. We're in a process where new firms are emerging and some of the old firms are dying. But when you listen to what is said by the CEOs of a lot of these firms, you have to read between the lines and see what's really being said, and you have to look at the numbers themselves. In my process, I look at probably 30 or 40 stocks every month. A very cursory view, a very rapid review. And from that, I will drill down on about 9 or 10 stocks, 8, 9, 10, somewhere in that range, and look at their financials and look at the comparisons and look at how they did last year, how they're doing this year. And from that, I'll take 1 or 2 and really look at the 10Ks and the 10Qs and dig into the real results. I'm less interested in hearing what the CEO or the CFO have to say because I really believe that what the Economist says is right. These people are on a carnival. They're there to be stockbrokers, to sell their stock, and to sell their story. To look at it, it's not what they say, it's what they do. And what they do is really in the numbers. And even the numbers tend to be confusing, like the reported earnings for Microsoft or the reported earnings for Valiant. You have to really drill down and find out what they're doing, and you don't see that until you drill down into the 10Ks and the 10Qs. A lot of technical information, and I read a couple of those almost every month, and then taking all that information, I only do 1 or 2 trades a year, but my process is not to listen to what is being said, but to look at what's actually being done. It used to be before the internet came, we used to have annual reports, and you used to get the same thing in annual reports. Annual reports used to paint a very glossy picture, but one of the best annual reports I ever read, or one of the most honest, I should say, it wasn't a good annual report, it was Tacoma Boat. And Tacoma Boat said, it's not been a good year. We're in actual financial trouble. We don't know if we're going to survive. I thought, that's honest. That's being there and actually analyzing in a realistic fashion the numbers. So along with that, I want to switch and talk. The Mariners are winning. So got to talk about baseball. I like baseball. I like baseball a whole lot. The Mariners are on top. But there's an analogy to investing as well. If you look at the modern age of baseball, there have been the 7 players, the modern age being 1921 to 1950. If you look at that period of time, from 1921 to 1950, there were 7 players who actually hit over 400. Means they got a hit 4 out of every time they came to the plate. They did it 12 times. Not each one, but a total. Between the 7, they did it 12 times. Since 1950, there have been no one that's done it. Not one single player. Now the average, if you take all the players, their average hitting statistics, the average in the 1921 time period, well, we're going to come to a break. Don't go away, because I've got a lot more. You want to hear my guest and that great hoax. Don't go away. We'll be right back.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our client's interests first in all portfolio decisions.
If you're looking for a home for your 7-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
We're back with more About Money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
I started talking about baseball. Started with the Mariners. They're winning. They're 2.5 games in front. But in the modern era of baseball, since 1921, the average player, if you take all their averages together, find an average, it's run between 250 and 260. That's 1921 to 1950. Since 1950, the average has run pretty much 250 to 260. Same thing. The average has almost been exactly the same. But we haven't seen any of those hitters that has hit 400 average. We've seen some get awfully close, but no one has actually broken through the 400 barrier. And the reason is that the standard deviation has been shrinking. In 1921, the average standard deviation was 40.6. In 2003, it had shrunk to 26.1. Now, what's a standard deviation? It means if you take all the averages and you chart them on a chart, you get a normal type distribution, those bell-shaped distributions, and it means 68% of the time, those averages are going to fall within one standard deviation. 95% of the time, they're going to fall within 2 standard deviations. 99% of the time, they're going to fall within 3 standard deviations. So it's a measure of the dispersion. And 5 standard deviations, there's 1 chance in 3.5 million. So what's happened that the standard deviation has been coming down? It's because players are more skilled today. Think about it. There was a big article in the Seattle Times way back when, in the 1980s, early 90s, 1980, 1990, right around that time frame, when we drafted, it had to be 1992 or 94, sometime in that time frame, when the Mariners had drafted Mike Moore as a pitcher for top draft choice. Mike Moore threw 95 miles per hour. That was pretty astounding. There were only half a dozen pitchers in the major leagues who threw 95 miles per hour. Today, you have pitchers that are throwing 100 miles an hour. What does that mean? From the time the ball leaves the pitcher's hand until it hits the catcher's mitt, there's 0.6 of a second. That's pretty fast. The players have become more skilled. The pitchers have become more skilled. The hitters have become more skilled. And the standard deviation has shrunk. Everybody has gotten closer. But the same thing has been happening in the investment world. In 2013, Credit Suisse report was done by a couple guys, and their names are difficult to pronounce, but you can look it up if you want to look it up. The name of their study was called Alpha and the Paradox of Skill. And they took a look at all the large cap mutual funds, and they found that the standard deviation since 1967 had declined from 16% to 6%. Fama, who shared the Nobel Prize, and Ken French did a paper that they called Luck and Skill in a cross-section of mutual fund returns. And they found that only 1 to 2% of managers have statistically significant skills when it looks at returns. For Fama, he did another report showing only 7% of money managers earn their fees, which means their returns are equal to the market when you discount their fees. So if the market is up 10%, those managers are up 10% after their fees are taken out. They're net of all fees. That's been happening in the investment world. And yet when you look at it, when you look at the returns that individuals are receiving, Dalbar does a report every year, and they looked at the last 30 years when you would think that returns are getting better because the skill of the managers is better. Actually, they're not getting so much better. $100,000 invested 30 years ago would have turned into $286,000 if it was invested in the average mutual fund. If it was invested in the Standard & Poor's 500, it would have been $2.1 million. That's the difference. Even though the skill level is improved, overlaying that skill level, you have individuals making choices to move things around. You have financial advisors making things to move around. And most often, it's at a disadvantage. It's at a significant disadvantage. Think about that. $100,000 invested 30 years ago would have produced a return of $286,000. For a lot of people that look at that and that say that's really nice to have seen a triple. But had they invested in the Standard & Poor's, it would be $2.1 million. And had they found somebody who could actually outperform the Standard & Poor's, would it be 2.5? Would it be $3 million? You know, that's possible. That's where all this is going. That's why it makes sense to find a very good financial advisor and find somebody that produces very good results. So that's the point of the first segment. I want to get to our guest, and I want to remind you later in the program I'm going to be talking about what many consider, or some consider, the greatest hoax of the 20th century involving painters and Nazis. That's coming. Stay tuned. But for right now, I want to introduce my guest. My guest is a person who was the CEO of a company 5.5 years ago. He's stepped out. He's doing the technical work, but he still is the expert and probably the greatest expert on search engine optimization that exists in the world today. My guest is Rand Fishkin of Moz. Welcome to the program, Rand.
Thanks for having me, Mike. I'm looking forward to it.
So, as we did 5.5 years ago, why don't we start with your background?
Sure. Yeah, absolutely. So I'm a college dropout. I went to the University of Washington locally here, grew up in the Seattle area, and dropped out only 2 classes away from graduating, much to my father's dismay at the time. But then started working with my mom, actually, doing web design and development. We got into SEO soon after that. SEO is search engine optimization. This is the practice of helping a website, a business, an organization to earn more search traffic from the non-paid results in a search engine like Google or Bing. And this is it's a very exciting, fun, interesting field. It's very technical. It's also very complex, and unfortunately, it was filled with when I started, and it's still filled with today. A lot of folks who are less than above board. A lot of scammers and manipulators and folks who might take you for a ride. When I entered the field, I struggled immensely to learn the practice of SEO, to understand how search engines worked. Google is pretty tight-lipped about how things work over there, especially for folks who want to improve their results. And so I created a resource at the time called SEO Moz, now today called just Moz. And the idea behind Moz was I want to make information about search engine optimization transparent and available to anyone. Google's mission is to organize the world's information and make it universally useful and accessible. And my mission is to organize Google's information and make it universally accessible and useful.
So somebody that has a website will see an increase in traffic if they optimize their website.
Yeah, absolutely. So Moz today is a software company, and we primarily work with consultants and professional marketers at firms and have about 24,000 subscribers to our product. And what we see is folks who can help their clients or the companies that they work at improve their traffic from search engines 5-fold, 10-fold, sometimes 50 or 100-fold. And that's pretty exciting, right? To imagine that, you could be the first person that comes up when someone Googles financial advisor Seattle, right? That kind of thing.
That would be awesome.
Yeah, I'll get right on that.
Okay. So what you have right now is really targeted toward marketing people.
Yes, it is.
And as the CEO or CFO of a company, looking at some of the things, I went onto the website, I went through the whole thing. I had an analysis done of my website. I'm not going to talk about how good it was.
Okay.
But there's terms which I don't think that most people understand what they are.
Sure.
Terms like reach. Tell us what reach.
Yeah, well, reach can have a number of meanings, but in general, especially in the world of web marketing, reach means the number of people that you are generally reaching with your message. So, for example, let's take Twitter. Twitter is a medium that probably most of us are familiar with. If I send out a tweet, my reach is calculated as the number of people who might have seen that tweet. Same thing if I put a post up on Facebook. How many people actually saw that post that I put up? In search engines, you might define reach as how many people searched for the terms and phrases where I appeared on the first page of rankings and people saw my listing and had the potential to click on it.
So in my case, somebody clicks on financial advisor. If my site comes up, that's reaching. That's a reach.
Yeah, absolutely, right? That would be one person reached if one person searched for financial advisor and saw you in the listings.
So for a CEO, for a CFO, looking at their website, looking at that whole idea of reach, they can get an idea of how many people are looking at their website. And what SEO Moz does is gears the website so you double or triple or quintuple or grow it even more so that more people are seeing that website.
Yeah, I mean, the idea behind Moz is really to be the software that serves the professional marketers who are doing exactly that work, right? They're trying to optimize the technical aspects of a website. They're trying to choose the right keywords and phrases. Maybe financial advisor is too competitive a term, or maybe it has too many ads on the page, and so the organic results don't really have a shot at earning a lot of traffic. Or maybe it's the case that not a lot of people are searching for financial advisor compared to searching for, an investment advisor. And so those folks are helping determine which keywords and terms to go after. They're also helping people produce the content.
So we're coming to another break. Don't go away.
Okay.
Because we've got a lot more to cover. And this is really important. This is the #1 search company in the country. You got to hear what he has to say. Be right back after this break.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I'm here with Rand Fishkin of Moz, the #1 company, really the #1, not any, I don't know, selling job at all. It really is the #1 company in SEO search. So Rand, one of the comments you made was about organic search. Let's talk about organic.
Yeah, sure. So when you do a Google search on your phone or on your computer, your desktop, your tablet, what you'll see is a set of results that contain basically two kinds of search results. One of those is paid, right? So you could become a Google advertiser by going to google.com/AdWords and signing up and paying them a cost for each click that they drove to your website. So you could say, hey, I would like to, I own a yoga studio in Seattle, and I'd like to buy an ad when someone searches for Yoga Studio Seattle. I want to come up at the top, and I'd like to pay some amount. Maybe that costs $3 or $4 a click. So every time someone clicks that, it costs $3 or $4. Then there's the organic results. Those are the non-paid results. Essentially, Google is delivering what they feel are the most relevant results through their crawling and indexing of all the pages on the internet. Those results cost you nothing, at least nothing in terms of paying Google money, but they take a lot of sweat equity. They take a lot of marketing and technical knowledge in order to access. And those results, on average, across all of the searches that Google gets, the 6 billion searches a day that we estimate Google is getting about now, those get about 80% of all the clicks. So the paid searches get a nice 20% of clicks, organic 80% of all the clicks. And so, you can see why SEO, organic search engine optimization, is so incredibly popular. People want that 80% of the clicks, and they don't particularly want to pay for them.
I want to ask about one more term. I'm asking about terms. But when we talk about shares, we talk about shares in a company.
Sure.
But when you're looking at SEO, you're looking at shares is something else. What do you mean by shares?
Sure. So generally speaking, when we talk about shares in the web marketing space, we're talking about social media shares, right? So someone shared a post on Facebook. They shared or retweeted something that you tweeted. They shared via Instagram by reposting a photo that you posted there. Shares tend to be a powerful metric for social media marketers and for social media in general, because it indicates that someone felt that your content, whatever you posted, was so interesting that they wanted to share it with their audience as well. And shares are often well correlated with how people rank in Google as well.
So if you're looking at just the website without looking at the social media, and you're looking at somebody who shares information from your website, that has to be pretty impressive.
Yeah, that's and certainly an important metric. The primary way that that's done on the web is still through links, the same way it was done, in the early 90s when web pages first came out. So if a web page on your yoga studio links off to, a physical therapist that you recommend in the neighborhood, that's an endorsement, right? Google considers that an endorsement of that physical therapist from your yoga studio. And they treat that as essentially a vote. Those votes through a lot of complex calculations and mathematics, translate into how well Google thinks you deserve to rank. So they look at a bunch of things, right? They look at the content on your website, whether it's relevant to the searcher's keyword. They look at the links that point to you, right? And they may look at some aspects of social media sharing as well to say, how many people have shared and recommended this website or this web page? They also look at engagement on that page. Do lots of people visit it? When people visit it, do they go back to the search results and choose someone else? Or do they stay on that page and say, this is a great result? And a number of other items, but those are some big ones.
So you've developed a program around, or software around each of those items, like Moz content, for example.
Yeah,
Tell us
we
very
have.
briefly about Moz content.
Sure. Moz content is really designed for those who are in the content creation and content marketing world, right? So if you are a startup and you're trying to create content to attract potential customers to your website, which many, many businesses do today. You mentioned IBM earlier on the program, and IBM is a great example. They've gone deep into content marketing and content strategy, creating a great deal of content, particularly around some of their machine learning stuff like Deep Blue. And I think that the content marketing field continues to grow as advertisers realize the value that it has, and companies all over realize the value that it has. Moz content is designed to help those professional marketers understand how their content performs against their competition.
So, in addition to content, you just released a new program. Tell us about that.
Yes. That was just 3 days ago. I was speaking at an event in Boston, woke up, jumped into our war room online and chatted with my team, and we released a product called Keyword Explorer. And the idea behind that product is to help people understand what terms and phrases people are searching for on the web and which ones they should potentially target. Which ones should I create content around? If I have my yoga studio and I'm trying to figure out, should I target Seattle yoga? Should I target Bikram yoga? Should I target Seattle exercise studios? What are the terms and phrases that are going to, A, bring me traffic because they get search volume, B, going to be easy enough for me to compete for, meaning there's not a lot of other websites that are extremely powerful and doing a great job already in those search results. Which of them, C, get click-through rate, right? Which of them actually drive clicks to the organic results versus ones that are overwhelmed, like we said, by ads or by images, by news results, by other kinds of things. And then help me prioritize that list of keywords so I know the right ones to target. It's been pretty fun so far. We've had, I just looked before I came in, I think we've had about 28,000 people try out that tool. So not too bad for the first few days.
That's an impressive
Thanks.
number.
Yeah.
So, for the average person, for the average CEO or CFO,
Yeah.
how does he go about using your tools?
Or she. Yeah.
Or she. I'm sorry.
No, that's fine. We really are focused on the professional marketer. So I think, if you're a CEO, you're a CFO, I would talk to your chief marketing officer, your CMO, or your VP of marketing, or your consultant, if you have a consultant or an agency that you work with, and say, hey, what is our strategy for targeting searches, right? Google is still, according to the statistics from someone like SimilarWeb, which monitors all the web traffic that goes around in the US, or a good portion of that, Google is still the largest driver of traffic to websites in the United States, and in fact around the world. They send more than 10 times as much traffic out as Facebook, for example. Google's driving all this traffic to websites. I think if you are an officer at a company, you need to have a pretty good understanding of what your strategy is. You need to be talking to your marketing team and saying, hey, how are we doing in search results? What are we doing to gain ground there? How are we competing against the other folks in the results? You might even go ahead and look at some searches, right? Ask yourself, what does my company do? What would my customers be looking for when they're seeking out my products? Go Google those things. Do you come up? Are you anywhere to be found? If you're nowhere, well, you might want to think about that.
Statistically, in the last year, I don't know if the statistics are for 2014 or 2015, 92% of people before they make a purchase will check out a website. 97% of people will check out a website when they're searching for a product. So if you don't have search engine optimization, you can be left in the dust and competitors can be winning.
Yeah, absolutely.
So how does somebody contact you or Moz to get set up so that they can optimize their websites?
Yeah, absolutely. If you're, if you're working with someone who could use Moz's tools, you can check us out online at moz.com. You're also welcome to ask me questions directly. I'm just Rand, R-A-N-D, at moz.com.
Thanks. Would you repeat that one more time for those who may not have had a pencil?
Oh, sure. It's moz.com, moz.com, and my email is rand, R-A-N-D, at moz.com.
Thanks. It's great to have you on. It's been 5.5 years. You're growing so fast, we have to cut down that time to 2.5 years.
That sounds terrific.
Time.
I look forward to it, Mike. Thank you for having me.
Thanks. So I mentioned before, the greatest hoax, for some people, the greatest hoax of the 20th century. What was it? There was a book written about it called The Forger's Spell. It's about Vermeer, a little-known painter in the 1600s. Very little known. He didn't paint very many paintings. Nobody knows much about him. You know, you may have recognized because they made a movie about the girl with a pearl earring. It's probably his most famous painting. But there is a hoax that involves him that was one of the greatest hoaxes that ever happened. He was almost forgotten for 200 years. For 200 years, nobody really understood who Vermeer was from the 1600s until 1881, when a little-known collector bought a painting for $200 in today's terms. Think about it, buying a master painting for what we would pay $200 for, a couple of $100 bills. It was grimy, it was rough handling, but that painting was the girl with the pearl earring. And by the turn of the century, prices had dramatically increased. Today, several hundred million dollars would be the cost of that painting if you were to buy it. I'll tell you more about the hoax when we come back after the break. So don't go away. This is fascinating.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our clients' interests first in all portfolio decisions.
If you're looking for a home for your 7-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So I've been talking about the greatest, or what some people consider the greatest hoax of the 20th century. It involved Vermeer, the painter who did The Girl with the Pearl Earring. For 200 years, nobody remembered Vermeer. It wasn't until 1881 when a little-known collector bought a painting for $200 in today's terms. Not $200 in those terms, but $200 in today's terms. It was a grimy, rough-handled painting that they cleaned up, and it turned out to be The Girl with the Pearl Earring. A painting today worth several $100 million. You know, but in the 1930s, there was a painter by the name of Rand Fishkin who labored to forge paintings by Vermeer, paintings that he called Vermeers. Now, you know, when anybody drops a lot of names, is telling a story, and they drop all sorts of names, you know, you can think about they know Trump, they know Obama, they know all this story. The more names that they drop, the more it loses credibility. So in the case of a forger, he doesn't copy everything. He copies it so well that he leaves some to the imagination. Every expert, whatever field it is, they acquire a feel for the artist who runs, and that artist, that feeling of the expert, he gets a feeling that's real. It's real, it's subtle, and they can't really explain all the time what it is. But it's those people who spend their entire life contemplating art, and they understand what it is and how it is, and they get a feel. They understand what it is. But in forgeries, in this case in forgeries, if the forgeries were too close to the reality to be an exact copy of what Vermeer would do, that would have made the experts uneasy, even if they couldn't indicate why. If someone wants to really tie artists and tie experts to the paintings, they need to leave some work to do, to collaborate, so that they found themselves hooked. So Van Meeringen sold fake Vermeers to the Nazi occupiers because in the 1930s it was the Germans which invaded Holland at that time, the Netherlands. And this is one of the guys who began to sell paintings to Goering and to Hitler. The experts declared the forgeries to be originals. Nobody knew much about Vermeer at all. They had a couple small paintings, the girl with the pearl earring, and 5 others. But Van Meeringen began to paint these paintings. And when you look at them, if you look at these side by side in a book, they look very, very similar. Different. You can tell that they're different, but they could very, very well be by the same artist. And so it was that millions of dollars were paid to this guy for forgeries. And it wasn't until they really discovered, and the war came to an end, and they began to hide these paintings, and the paintings were discovered, that they began to realize that these were really forgeries and not the real thing. Very, very close. He spent a lot of time developing techniques to make the paint look old, to make it look, with the cracks in it and with all those things. Spent his time to make it very, very similar to what the reality and the real paintings were. Great hoax. Millions of dollars put away. And he could have sold those paintings had the Germans not invaded Holland. He probably would have sold them to the French and to the Italians and to the Spanish and to Americans as well. All of the experts from all those countries declared that his paintings were real, not forgeries, until it was discovered he was forging the paintings. Several times I've mentioned in the program structured products. Those are products which are based on something that sounds real, but in fact is similar, in my opinion, to a forgery. Products. There used to be, at the time of the .com, there were a number of products that were developed. And Wall Street exists with a lot of very, very intelligent people who are developing products that sound so awesome and so real and sound like they're really something where you can get a good return with less risk. those products generally create a lot of fees, and a number of times actually fold up. There's one of the products which has been developed, and I think it's a structured product which is being sold again and again as income product, is the annuity. Elizabeth Warren has just came out a few months ago and has said that 13 of 15 companies selling annuities are paying financial advisors huge sums to market the annuities. How they're sold is in groups. They invite older people, primarily older people, to a lunch or to a seminar where they explain that this is guaranteed income. But usually they don't start that way. They usually start by saying, remember 2008, 2009, how everything went down? They create a whole atmosphere of fear. They create this whole idea that you could run out of money and that they have the solution. Very similar. Most structured products are sold in the same way. It's a solution to a problem which they readily get you to recognize. And we have this natural tendency to have a greater fear of losing money than we do of rationalizing expectations. So with these annuities, they're sold. Develop a sense of fear and then come with a solution. But for the annuities, they're considered to be extremely complicated, difficult to understand, and not a great investment. That's not just me saying that. That's people like, and I don't agree with most of what she says, but Susie Orman has that to say. Elizabeth Warren has that to say. A number of people have said that and feel that it's not a good investment. There are certain people that should have that locked-in income. But for most people, they can do much better with something different. It's very similar to really, really great investments. It has a lot of the characteristics, just like those forged Vermeers. Very, very similar, and yet enough different that it grabs you, it builds the emotions, and it makes sense when you think about the problem and a solution, even though it's probably the wrong solution. Anyway, that wraps it up for today. I will be back next Friday, so have a very wonderful week and enjoy all the good weather. Until Friday, I am gone.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3 for more About Money with Mike Adams, here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com. The following